Well, good afternoon and welcome to our High Rock weekly client webinar. If you want to skip over any part of this webcast, feel free to use the fast forward control on your screen. Otherwise, sit back and enjoy. Each week on this call, we try to talk about what we see developing in the global economy, in financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. I'm Scott Tomlinson, and joining us on the call today is my partner and colleague, Paul Tepsich, the founder of High Rock. Well, each week we record this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this, and all you need to do is visit the homepage of our website and click on the Introduction to High Rock Private Client button. We do have a new look to our website. If you want to have a peek, you can let us know what you think. Well, in a bit of a different take on our weekly webinar, we're going to focus on one specific topic today. And as all recently received your quarterly portfolio summaries, it includes a graph that is similar to the one here. Now, we thought we might elaborate on what it all means and how you might relate to it. Now, the above client example is a client who has been with me from before we began High Rock and is also fully invested now in our three models: 40% fixed income, 50% in global equity, and 10% in the tactical model. Now, if you've been with us for a shorter period of time, you may not yet be fully invested because we've been waiting for the appropriate opportunity to make some purchases for your portfolio. So your portfolio performance may not look the same. However, it is our full intention that over the next few years, your portfolio will gradually begin to look like this one. Basically, we want to grow the green area, which represents portfolio growth above what you have deposited, which is the gray area. Now, in this example, the green area has grown at a rate of 7.78% over the last 5 years or so after fees, and it has grown over the last 12 months at a rate of about 4.79%. Paul, any comments you want to make on this at the moment?
No, not yet. We can go into more detail perhaps in our models a little later on, right?
Yep, absolutely. Just wanted to see if you wanted to chime in. So how does this compare, and what are we comparing it to? And that really is the key question. In our client note that you all received with your portfolio summary, you received this table. So what is this? We did provide a bit of an explanation in our client note, but we thought we might break it down a little further for your clarification. Now, this table contains the performance of what we call our benchmark. And that is a combination of three indices that resemble the approximate composition of a 60% equity, 40% fixed income portfolio. The 60% equity is a combination which is 30% of the Canadian equity index, which might resemble the Canadian stocks and REITs in your portfolio, and in a similar portfolio, and 30% of a global equity index represented by the All Country World Index and contains the approximate allocation to international stocks. 40% is fixed income represented by XBB, which is the Canadian Bond Index ETF, and that contains Canadian and government corporate bonds. So we go to our data source, Bloomberg. That gives us the total return analysis for the certain time period, and in this case, we're looking at a 1 year on a monthly basis for each of our relative indices. Now, in this case, the S&P TSX, which has grown at a rate of 9.2% over the last year. Hope that's fairly clear. Now, Our next equity index is the ACWI ETF, or All Country World Index ETF. And here showing an annualized rate of growth of 23.4% over the last year. But this is in fact in US dollar terms. And because all of our client portfolios are consolidated in Canadian dollars, we need to make this adjustment. So in Canadian dollar terms, because of about a 10% improvement in the Canadian dollar, this return actually gets reduced to a little over 13% over the last year. And there it is there in our matrix. Now, bond prices pushed lower by higher interest rates have returned a negative 3+% over the course of the last year. So there we go, put it into our matrix here. So because of the weighting we give each of these indices, we then break it down to determine what the combined total return contribution of all three are for our blended benchmark. So 30% of the S&P TSX returning a 9.2% gives us a 2.76%, and similarly for the Canadian dollar ACWI, add 3.95%, and then for the bond part of the portfolio, we are actually taking off 1.26% because of the negative return. So all totaled up, we get a 5.45%, and that's the blended 1 year benchmark return. And then, of course, because we want to compare apples to apples, we want to reduce it by the fees that would be in your portfolio. And so your portfolio that you will see is net of fees in your summary. So here we have all the data that we put together, and that ultimately goes into this matrix. Paul, any commentary yet?
Nope, still no commentary.
Okay, so
keep going. You're doing great.
Yeah. Okay. So basically, what we're doing here is trying to determine what those 1, 2, 3, and 5 year benchmarks are, not just for the 60/40, but also for a portfolio that would be more oriented toward fixed income. So that's another option. And then you can see we put together that 1 year period there that the benchmark combined has returned a little over 2.5%. And then, of course, taking off the fees, it comes out to a 1.4% return. And there again, we can compare the 1, 2, 3, and 5 year periods. So what do you do when you look back at that portfolio? Well, here's how that client portfolio looks. Again, the 1 year return at 4.79 relative to the benchmark, and again, all this is after fees, of 4.3%. And of course, we have the 5 year return, a little over 5 year, but basically a 5 year return of over 7.75%, with the benchmark after fees being just a little under 7%. So in both cases, we can see we're a little ahead of the fully invested benchmark. And don't forget that in most of our client portfolios, in fact, especially in this client portfolio, there is an overweight of cash or money market investments, and that also means that the portfolio is not fully invested, whereas that benchmark portfolio is actually fully invested. So again, from a risk perspective, we've lowered the risk that we are exposing this particular client to, but all of our clients for that matter. And it's also important to look at returns that relative to risk. We've talked about this lots of times in the past. We want to make sure that when we're taking risk, it's risk that will get us a better return, but on what we would call a risk-adjusted basis. Historically, we have taken less risk to achieve better returns over longer periods of time. We may not necessarily always outperform a fully invested benchmark in the short term, but by being strategic and tactical, we can lower longer-term risk and limit the potential for wider swings in portfolio value, which in the end allows us to better compound returns over longer time frames. Paul, have I missed anything?
Well, no, that chart everybody should be well aware of and understand how we look at returns and risk. So that's, we say it all the time. We manage risk first and foremost, and returns are the result of well-managed risk. So we've got our eye on the ball in this stuff. It doesn't mean we're always going to be right, but it means we can try and reduce the most amount of risk we can while still achieving our financial goals according to our wealth forecast and investment policy statements.
Absolutely. And as you just mentioned, we do take everything in the context with the wealth forecasts. We are always working diligently toward achieving each client's specific long-term goals as set out in the wealth forecast. These goals are intended to be achieved over a longer time horizon than those that we might achieve in any given year. But if you do wish to review your wealth forecast and any part of your strategy, we are always available to do so.
Scott, I've got a question for our listeners. I think everybody can read what most of those assets are, or different accounts: real estate, RSP, TFSA, non-registered investment, which would be like a cash account. Do you want to explain CSV?
Yeah, sure. So in this particular client's case, and in fact, I used this in my blog yesterday, Paul, so thanks for bringing it up. But that's the cash surrender value of a life insurance policy. This particular client, many years back, we because their situation determined that they could use a little bit more life insurance, and we focused on a whole life insurance policy because one of their end goals was to have as much of their estate as they could have to pass on to their beneficiaries in as tax efficient a manner as possible. So two very good vehicles for that obviously are life insurance, because it passes to the beneficiaries outside of the estate and therefore it is tax-free, as well as a TFSA, which is a tax-free vehicle as well. So you can see that the TFSA, which is the gray part of this chart, if you go to the end of this, you'll see there's a significant part, almost I would say half is a combination of what's left in the TFSA and the life insurance, and then the balance is real estate and what's left after the RSP has been paid out over time. So always interesting. Obviously, each client has a very specific situation, but we try to find all of the solutions to whatever their specific and particular challenges might be. In this case, one of those goals was to have some tax-free money at the end to pass on to the beneficiaries, and it turned out that the whole life insurance policy made tons of sense for them. Does that make sense?
Great explanation.
And of course, we remind everyone that historical returns are no guarantee of future returns, but at High Rock, we do work very hard to provide our clients with the best possible risk-adjusted returns. As well, within the context of your wealth forecast, speaking of which, we can, with your approval, always make adjustments to your allocations to each of our models if we collectively deem it's appropriate to the ultimate attainment of your goals. So something always to keep in mind when we do our 6-month reviews, not only do we want to make sure that your well forecast is moving forward as we anticipated it would, that we're making the appropriate adjustments as we monitor it along, but if there are other changes that we need to address, we can make adjustments to your weightings in each of our specific models. All right. Well, Paul, anything to add before we move forward?
Yeah, we might want to go into a. Do you want me to talk about any trades that were done now, or actually what's inside, specifically tactical, and how we come up with that 30% of Canadian equity component?
Yeah, you can. Why don't I slide just back to the breakdown a little bit, and then you can talk about that for sure.
So, as you can see, for the average 60/40 equity 40 fixed income client, we've apportioned 30% to the S&P TSX, which is the Canadian Composite Stock Index. The way we do that is we have, for this particular client, it's a weighting in actual Canadian stocks, more large cap, of somewhere around 15, 16%, call it. And then we have a portion, actually all of the tactical model gets apportioned into that 30% SP TSX as well. So that balances out to around 30%. And the reason why we do that with the tactical, although the tactical is not a pure Canadian equity model at all. In fact, most of its risk is in some various high yield bonds. In fact, we just added one yesterday that I blogged about. I think yesterday, last week. Sorry, we added one last week and we added one today. Both which worked out well. They were both new issues. So that Canadian tactical, even though those are high yield bonds, those specific high yield bonds in the tactical model get allocated as equity risk. So we're being a little more conservative, if you will. And then this 30% ECWI is self-explanatory. Those are pure equities across all those various jurisdictions, geographies, and different types of markets. And then the XBB, the Canadian government, it's a bond universe. Canadian governments, provincials, municipal bonds, investment grade corporate bonds, and even some high yield in there. In our fixed income model, we look very similar to that. We do hold Government of Canada bonds, we hold investment grade corporate bonds, we hold some Canadian high yield bonds, but they are slightly better rated, and maybe not quite as risky as some of the ones we hold in the tactical model. So the tactical model high yield bonds we apportion more risk to those. And we also have our preferred shares in our fixed income model. So all that balances out, and that's where you get that 30% split in the SPTSX. Some of it is Canadian equities directly, and some is from our tactical model. Hopefully that explains the pie graph that you're going to. And we should just add, there's a lot of data here, a lot of numbers. If anyone has any questions and wants further clarification on exactly what's in all of our models and why, they should feel free to contact us at any time. We can have a more in-depth discussion. There you go.
Absolutely. And one of the things that we want to make sure is that those who want to have a more detailed understanding of some of the things that we're doing and why, and why we don't necessarily always want to rely on the standard indices for our portfolios necessarily, and the risks that are involved in doing so. We're always happy to do discuss that in more detail. And in fact, going forward, we are going to try to move forward from a technological perspective. So next Tuesday, if we can get the technology right, we're going to be turning these webinars into video presentations. So you'll have both Paul and I discussing certain topics on a video, which may hopefully be a more accessible medium for our audiences. Anyway, I hope that this presentation today has been informative. And as Paul said, anytime you want to send us an email or ask questions regarding why we use the benchmarks that we do and what are what's the rationale. We hope we've got that across today. But if you have any questions about that, please don't hesitate to be in touch. Anyway, thanks for tuning in as usual. And we will endeavor to send you the next technologically updated version, video version of our webinar next week. Until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we want to wish you all a great rest of the week and a wonderful weekend.